Hello, everyone, and welcome back. My name is Greg Furman, and this is the VantagePoint AI Market Outlook for the week of March the 8th, 2021. Now, to get started this week, we're going to begin where we always do with that very important US dollar index. Now, the dollar has made a very strong move here, which is perfectly normal at this time of the month. At the beginning of the month, usually we see dollar strength each month between the end of the month up until about the 10th of the day of the new month. We can see the dollar really pushing through, but this week is a little bit different here. We've got a swing high at a verified resistance high at 91.60 that the dollar has managed to close above on Thursday. And then on Friday, we made a nice clean break of this. Now, what we have to be cautious of in a scenario like this is, again, it's made a big push based around the non-farm payroll number. That payroll number was pretty good, but the U6 number was flat. So I always take that with a grain of salt. But what I've often seen after the non-farm payroll number, regardless of how good that number is, the dollar often cools off by Tuesday or Wednesday. Now, this particular situation is different. I've shown everybody the monthly patterns, and that March, the seasonality is usually the dollar is strong right up until about the end of the month. We'll see if that comes to fruition. Now, Chairman Powell has definitely given the dollar another boost, talking about interest rates. And again, I don't think that's going to hurt the equities as much as what they're suggesting. But for now, this swing high, we want to make sure that we're holding above this particular level. Our T-cross long now comes in at 90.86. We must hold above that if the dollar is going to continue with further gains. But in my respectful opinion only, this level at the 91.60 is the one we need to watch. Now, if we click on our F8 in our software using the predicted moving average by itself, getting that pivot area, 91.29. So if we get below 91.60, no need to panic, but watch the 91.28 area. This is the level that we're likely going to see it retrace to, and we would look for it to hold. Once again, we want to really avoid using any kind of overbought, oversold type of signals, particularly at this time of year. The dollar had a very poor year in 2020, but 2021 is certainly looking much, much better for the dollar, provided we hold above these levels, and of course that all-important level, the yearly opening price at 80, about the 89.80 mark. Now, one of the driving factors, again, that's pushing that dollar higher is there's just no gold buyers, and rightfully so. In my respectful opinion, again, only, it's going to be very difficult for gold to recover here as money continues to pour into Bitcoin. Now money is going into the dollar when they're talking about raising interest rates. That's a gold killer here, guys. Now, we are sitting right at the bottom end of this particular range, and that low end that I've talked about over the last several weeks, it is coming in at about approximately the 1704 level, and we can identify the specific level there, and it's coming back into these swing lows. But again, this is where it's kind of a make or break time for gold, to be perfectly honest. Now, when I look at this from the previous calendar year, the bulk of these gains, if not all of these gains, came from COVID, and that's where the bulk of the euro-US currency pair, where it made its gains. Now, with COVID starting to turn the other way, the vaccines are working. Gold has really done nothing since this swing high going back into approximately August 2020. It's been on the decline since. Now, if we break through the lower end of this particular range at the 1706, that's the June 5th low, then that would suggest a deeper move to the downside in gold. That's the likely outcome here, guys. Nothing's 100%. But when we look at fair value pre-COVID on gold, that's around the 1500 mark. So that's where I would put gold in the coming months ahead. But again, this is a weekly outlook. This is not a long-term outlook here, guys. It's 1 week at a time. That's how we take on the markets here. So again, we'll continue to monitor the bottom end of this range. I would expect we would see some potential buyers here. Now, if we do, we want to look for that retracement back to the VantagePoint T-cross long, 1768. If we click on our F8, we've got our predicted moving average by itself, which is 1723. That is between 1723 and 1768 is likely to contain any of the gold bulls. It's very unlikely they're going to get past that particular level. Now, one of the reasons that my view is that is because of Bitcoin. Bitcoin, even with the dollar rally last week, stocks kind of soft. Bitcoin held its value firmly above the yearly opening price at 29,000, and again struggling, all tangled up in this VantagePoint T-cross long at 48,270. So I would look for Bitcoin to likely recover when the dollar softens up a bit on Tuesday or Wednesday. But we have a buy signal yet again on Bitcoin here, our medium term crossing our long term predicted difference. But again, we want to watch these momentum-based indicators because when we're looking at them closer, we can see the medium term crossing the long-term predicted difference is what led to the dollar rally, breaking and closing above that predicted moving average. We would look for Bitcoin for a very similar. If we click on our F8 in our software, we've got our predicted moving average, and you can see very sneaky there that it closed just above that blue line at 49,059, the long predicted 48,681. So we would like to hold above here. Just remember, Monday is not usually an accurate trading day. Whatever happens on Monday often reverses on Tuesday. Then on Wednesday, we see the real price again. So be cautious with this. But again, we're still holding that bullish bias in Bitcoin. And again, that is another nail in the coffin, in my respectful opinion, for gold. When we look at our stocks going into next week, good recovery. Once they digested that non-farm payroll number a bit and they could get their head around it, then all of a sudden they realized, well, maybe that's not such a bad thing for stocks, even if the Fed does hike a little bit, but it's showing the economy. The US economy is coming around. There's a stimulus package coming in. These are all interest rates potentially going higher. These are all positives for the US dollar and potentially for the S&P 500. So what we need now is to clear the T-cross long at 38.53. We're closing the week at 38.39, a very, very volatile week after Thursday's Fed chair's testimony. But again, if we click on our F8 here, we can see on our F8 that we've managed to close the week just above that predicted moving average. That's a pretty impressive move there. So we'll see if we can hold above 38.32. But again, if we have another sell-off in equities on Monday, that would tell me on Tuesday we're probably gonna go higher. Now, with oil, of course, following or actually leading the equity markets, oil ignored that sell-off in the S&P 500. We came down, retraced exactly to the VantagePoint predicted moving average, that coming in at 59.92. But OPEC plays a part in this. From their meeting, that boosted oil prices. I'm not 100% convinced that oil has a lot of upside from here, but we did break above our swing high, our verified resistance at 63.81, but now we need to hold above 63.81 to make sure that this actually is a bullish move, but it certainly looks like it after this corrective move lower, but oil will need stocks moving higher if it's going to move higher also. Now, as we move into our main Forex pairs, again, the Euro US, that warning that I gave everybody in last week's Forex Weekly Outlook, that the Euro, much like the yen and the Swiss franc, they're going to follow gold contracts. If gold is moving lower, that is not good for the Euro currency or the Japanese yen or the Swiss franc, but it's really helping out the dollar here. So this bigger move down on the Euro was anticipated with the sell-off in gold. Now, we've taken out a pretty strong level here at this low of 1952. To start the week, we want to monitor this level very, very closely. Our T-cross long is sitting at 120.72. But again, if we click on our F8 in our software, they're long predicted at 2015. We're looking for a retracement between 1952 and the 120.51 to begin the week to look to reset short positions against the euro, provided gold contracts remain depressed below that 1768 mark. So again, very high correlation between the euro and gold contracts. Our indicators from VantagePoint predicted differences are down. Our MACD is crossed down and below the zero line. RSI momentum still down. We are getting oversold here, guys. But once again, over the trading overbought and oversold signals is about a 50% accurate. You're telling the market to stop going lower and turn around and go higher. That's the basic synopsis with an oversold or overbought condition. We don't want to do that. We want to follow the intermarket correlations. We could be moving in to more of a trending move on the Euro US, which after a retracement, we could see a push into the 118, 117 mark. So watch that one very, very closely. Now, as we look at the counter to Euro US is US Swiss franc, a big move up here. But again, understanding these moves, using these predicted moving averages from VantagePoint, and again, these key pivot levels. Now, when we look at the correlation, the Swiss franc definitely does not like gold contracts moving lower. The Swiss franc feeds off of gold strength or weakness. So in this case, with gold being extremely weak, it's really putting pressure onto the Swiss franc, and the dollar's making very strong gains here. Now we've moved quite a bit off our T-cross long at 90.84. A retracement is perfectly normal here. If we click on our F8 in our software, we can identify that key pivot level, which is coming in at 92.04. Our predicted low is 92.67. So if you're going long on this pair to start the week, you want to focus your levels between the predicted low and the long predicted pivot area at 92.04 with a clear bias to the upside. Now, the British pound, again, it's coming under pressure on broad dollar strength. However, remember the euro US and Great Britain US are two completely different currency transactions now with Brexit. So we've got very strong verified support at 137.75. We want to see if this level is actually going to hold here because again, this is very significant support. We are again very oversold here, but this move appears to be just getting started. But what we want to watch very closely to begin the week is to see if we can actually close Monday and Tuesday above 137.75. If we can, then that would breathe some life into the oversold condition of the RSI. But my optimism on that remains guarded. I think the dollar has a little bit more strength in it before we get a bounce back up on the pound. So I'll watch the level between 137.75 and this lower end at 135.65 for the opportunity to again set additional long positions. Now, with the dollar yen, very much a US Swiss franc trade. You can see that these two charts are almost identical. If we look at this for a minute and we look at the blue line, all three of the predicted moving averages, we go back and have a look at the Swiss franc, very, very similar trades, almost identical, I would argue. So again, if gold contracts break down and start moving towards the area that I've suggested around that 1560 mark, then that would put the dollar yen well over 110 in the coming weeks and months ahead. Same with US Swiss franc. They would both continue to move higher as gold starts to plummet. Now, again, this is understanding intermarket correlations and how they work. They will always trump basic standard indicators, but the predictive indicators, they're a little mixed here. Our predicted differences are stacked on top of each other. So if it was a little bit overbought, any kind of retracement is perfectly normal, but these verified zones are telling me that we are likely on our way to the 110 mark. Now, with US Canada, one of the most frustrating pairs lately to trade, but these verified zones are just relentless. They will not, the market cannot get past them. Every time we come back up, you can see we've got a lower high, and even that one, it's kind of the same, but it's still technically a lower high. And we're making lower lows. So my bias for this to begin the week with oil contracts at light sweet crude at $66 a barrel, S&P 500 looks like it's about ready to recover here. That would tell me that I would be looking for shorts on the US Canadian pair around the 127.20 mark, 127.18. That's a reasonable trade. Now our neural index is saying the immediate move, however, is going to be the upside, 126.56. We're all tangled up in here in these predicted moving averages. When we click on our F8, This is the level, the line in the sand to begin the week for us, 126.45. If we start breaking down below that level, then we are likely going to take another run at the 124.65 area. But if we can hold above 126.45, then we should easily hit the 127, about the 127.60 mark. But that's going to be a tall order, guys. If the S&P goes up and oil goes up, that's going to be very problematic for longs on this particular pair. My bias at the current time is, at least for now, is slightly tipped to the short side. The reason I'm saying that is because of light sweet crude oil contracts, and the economic data coming out of Canada on Friday was a little better. But the broader way to look at this is that Canada is nothing more than a feeder fish off of the US economy. If things are looking better for the US, they're definitely going to be looking better for Canada because it's their biggest trading partner. There could be a little bit of tension, but in this new relationship between the new administration and the administration in Canada, there's already been butting some heads over the Keystone Pipeline, but we'll see. Right now, it looks like it's a positive for Canada with the U.S. doing well, so go with that for now and look for a move lower. Now, the Aussie and the New Zealand, both of these two currencies will again follow the S&P 500 above all else. So if the S&P can recover, the only thing that I would exercise some caution is that if we think the Fed is getting ready to raise rates here, that is going to be a negative for the Aussie and the New Zealand and potentially the CAD, these currencies that are following the S&P. So when I'm looking at this right now, to begin the week, our T-cross long 77.72. It's short while below that level. But if it gets above that level, then shorts are off the table. One of the ways to gauge that, click on your F8, get that additional long predicted 74.47. If we can get back up above that, then the pressure will be off the downside. That would tell me the S&P is recovering. We're in a risk-on environment, and the dollar should soften up a little bit against the Aussie. And of course, the New Zealand, we would see it soften up a bit against this pair also. But once again, very, very heavy support here, guys, sitting at 71.05. So we've come down and kissed that level at the 7100 mark on Friday. But again, only in my respectful opinion, the unemployment number was good, but always check the U6. The U6 was dead flat. So that tells me the labor report, things are improving in the labor market, but maybe not quite there yet. So I am expecting the dollar to soften up a little bit potentially this coming week once everybody is in and they all kind of digest that very complex U.S. labor report. So with that said, this is the VantagePoint AI Market Outlook for the week of March the 8th, 2020.